Let's get some additional insight on China's property sector with John Saunders, Managing Director at MGPA here in Hong Kong. Thank you so much for joining us. Appreciate it.
Pleasure.
He runs two Pan-Asian property funds, total size of $5 billion US. First and foremost, let's just talk about the breaking news that Paul was just talking about. Yep. What are your initial thoughts?
Well, I suppose China's in a bit of a bind, isn't it? I mean, on the one hand, it's announcing stimulus packages to try and make sure that their economy continues to grow robustly. But then at the same time, they are very concerned about excess growth in the property sector. So last week, you already saw a number of measures to effectively tighten credit and the availability of mortgage financing, particularly for people who are buying second and third homes. Now there's big talk and big discussion about some additional taxation coming in. But again, it's not geared towards people buying their first home or buying the home that they live in. It's geared to trying to take the speculators out of the market who've been driving residential prices as much as 10% a month in some areas.
What is the Chinese real estate market like for someone that's just becoming very interested in it? How many buyers are there right now that actually have the funds to buy not just their first property, but their second, their third, their fourth property?
Well, on the face of it, it seems there are a large number. I mean, like all countries, you know, there is a increasing gap between rich and poor, and so you get the very wealthiest of people, especially those who created large amounts of wealth in new industry and indeed some old industries who are capable of buying many multiples of real estate. But I suppose there's this pervasive thought that it's one of China's best ways to, or one of the Chinese people's best ways to store wealth and create wealth. And so I think that's what's worrying the government. You know, there are too many people speculating on residential property, and they're trying to just, you know, curb that a little bit.
But it's the government will likely find itself in a tough bind because you want to curb the speculation, you want to prevent a bubble, but you don't want to stifle growth. Yeah,
exactly. And I mean, the danger with messing with property markets, I mean, almost every country in the world, you could cite examples, whether it's the UK in the very late 80s, whether it's the US in the early 90s, Hong Kong pre-97. There's a horrible feeling that every time a government tends to try and interfere with property markets, whether it's taxation or restrictions on lending, etc., that you can end up with some external shock coming through, which then causes more damage than they were expecting.
You mentioned the UK, you mentioned the US. What lessons can China learn from other markets that have had troubles, and most recently the real estate bust that happened in the United States?
I suppose one of the big lessons they can learn is the hardest. It's actually very hard to control property prices with external measures. So sort of government taxation, restrictions on second homes, etc. They don't actually have a terribly good track record of curbing prices, because what tends to happen, and in fact, you know, let's be frank about this, you know, China's been putting measures in place to slow down their housing market since, I think it's 1994. And typically what happens is a measure's put in, you know, the prices sort of stabilize for a little bit. Sometimes the stock prices come down, and then people almost think, well, okay, if the government's trying to stop this, it clearly is, you know, a really good bet, and therefore we should go in. So the fear is the external shock, to be frank.
And with the government trying to, again, curb this bubble, what does this all mean for the property developers themselves?
Well, clearly the property developers are concerned, and you've seen a number of developers come out with various sort of guarded comments about what the changes might be and what they should be. You know, the developers, though, are running enormously profitable businesses, and I think the sort of Chinese authorities will have a tendency to look at that and feel that if they're curbing speculators and curbing some of the excess profits within the real estate manufacturers, if you want to call them that, the developers, I don't think they'll feel that that's a terribly bad thing. It's kind of a vote getter, and I don't think they will feel it hurts terribly many people.
Just hazarding a guess here, it's pretty interesting, I bet, to study this market.
Sure. No, it is. It is. I think the thing to remember about China, though, it's a bit like talking about America as a homogeneous market. I mean, you know, Beijing is radically different from Shanghai and is certainly radically different from many of the different provinces. So you can't sort of lump the whole thing into one.
It's hard to make generalizations.
It is hard to make generalizations. But if you were to make a generalization, it is that, you know, China has done amazingly well off the back of its growth and its stimulus package that was large and put in early. And now, as Paul said, there's talk of another stimulus package coming through. You know, when you've got a GDP that's growing at sort of 8–9%, that tends to be quite inflationary for real estate, and that's the big generalization. And of course, that's frankly what the central government is a little bit concerned about.
Really appreciate your insight again, John Saunders, Managing Director at MGPA here in Hong Kong. Thank you. Pleasure meeting you.
Thank you very much.
Thanks for your time.